Indiacharts publishes Nifty Daily, daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
The really big thing to note about the sentiment in the market is that every time you have a down day, and especially one like yesterday, which has been rarer and rarer in the time, but we have seen it at least in specific indices like the Bank Nifty had several big down days that everybody starts talking about whether a major top is in place. Now, we are in late stages of this current move. So as you get into a later and later stage, and I say current move meaning from the low that we made in the month of May as far as Nifty is concerned. But you're looking at the chart of Bank Nifty, something I covered a week back, and I said Bank Nifty will probably along with financials explode on the upside. Now when I use that kind of language, and I used it only in the headliner, which is more attention seeking but and catches most traders. And moment it falls for one day, everyone says, oh, well, see how wrong that was. But then that video was put out 1 week ago when the Bank Nifty was 22,000. So even after yesterday's sell-off, we are more than 1,000 points higher. The real question is not where we are, but where we are likely to go. So do we really take the one-day knee-jerk reaction, which I was simply writing about based on what we were seeing on this chart, which is the mid-cap index. This is the BSE mid-cap. You can take the NSE or you can take the small cap index. In all of these cases, what we could see at the top end is this RSI indicator had almost reached a relatively high level, around 83 here. It was almost 84.5 or more on the NSE mid-cap index. So almost 85, which is a relatively high reading when you go back historically. When you don't get many such readings, probably have seen them at the highs of some important top, like this one is closer to around in the 80s. And moment you reach the 80s here, you see some knee-jerk reactions. Now, of course, after that, it still stretched a bit higher, developed a negative divergence in the RSI, and then finally, you got a much more steeper correction. So even the high readings, the super high readings that you get, only initially give you a correction. They are many times they are not the final top, is what I've noticed, because what they reflect is a very, very strong move. And when there is such a strong move, even the dip gets bought into, and then eventually you still see higher highs. And more often than not, the final top is made on a negative divergence. So the way I'm marking the mid-cap index is still a fourth wave, which means there's still something left. What we did end up seeing yesterday, and I put out one chart, I think the mid-cap index only, or the Nifty itself, that we've fallen back to the 20-day moving average right here. Okay, and this is an important support. I think all indices except for Bank Nifty ended up at this level. So the Nifty is also back to the 20-day average. And we're going to watch whether this holds, because most of this rally from May has essentially ended up doing that. That is holding the 20-day average. So that becomes the critical pivot. Momentum indicators haven't done so well. They've whipsawed both ways, buy, sell, buy, sell. You had multiple swings throughout this period. So you end up using what works. In some charts, Trendlines worked for a while. Right now, we are also very close to the lower end of the support line as far as the trend line is concerned. Even if I switch to, say, the Nifty itself, the trend line of from the March bottom into the May bottom had actually broken in June itself. So in fact, the start of August. And when that happened, it may have looked like you've broken a move. But in terms of the structure, in terms of wave count, something was not complete. Stocks were still moving up, I think. And so the trend continued. And so what you really do is you end up taking on new steeper trend lines. And yesterday's move actually again breaks, even if I take a trend line from the more recent lows, it breaks that as well. So it does definitely raise a question. It's a very big candle. But the fact is we've seen big candles in the past. For example, if I just go back to some charts from several years ago, because I noted that many times when you would get a rally, and this was during a bullish phase, moment you would break out into a new wave, you would get a pullback, and you'd get a sharp pullback sometimes, which would end up almost testing the 20-day average again. You can see this here. Sometimes some of these moves were also backed by meaningful volumes. Of course, this sell-off doesn't seem, I mean, there is more volume, but it's not a big spike. But some of them did have it. You have another one here. So if you just notice this, the market was moving along and then suddenly you get this one big candle. And so it may look like, okay, now this is it. But it didn't take time to really recover back above that. So when you get a one-day move, you really need to judge whether that one-day move was a normal market day or was it news-based like yesterday. Now, even this day, there was no news. I remember, and in hindsight, people would just try to figure out what really drove that corrective structure. So it's not always that you get something to explain what has happened. A knee-jerk reaction, you really have to test in terms of what your view is in terms of the momentum indicators and in terms of the wave structure itself. You can't really, apart from that, judge what is happening. So once you can take that call, and so my sense is, while on the Nifty you can get a little shaky because the Nifty, like I said, has broken certain trend lines. But when we start looking at the Bank Nifty, which is what the whole point was, that you have a certain sector which is an important part of the Nifty itself that is moving up and contributing, can you really get a major sell-off? So in terms of the structure here, Bank Nifty's momentum indicators still not crossing back to the sell side. There's no trend line break that I can really make up over here. Even if I draw a trend line from this low, it will be much below where prices are. And so you'll need further confirmation in terms of the minor wave structure also, at least from the low that we made on the 17th of August. If I try counting this, I would mark this as 1, 2, 3, 4. So you really don't have a fifth wave. Something is pending, and that would keep me positioned to think that something on the upside can still play out as far as the markets are concerned. So not completely convinced that the one day panic reaction or manic reaction yesterday really changes anything in terms of the trend. If of course you see a further decline, then I might complete the move that started from May. But right now, this is what the banking sector, which has been the recent best performer, is indicating. And with that, then all focus quickly shifts towards what is happening in global markets. Have we seen a big shake-up? Not. And some global markets actually not participating on the upside that we are seeing in the US. Like there's still a lot of volatility in Australia. Even several of the Asian markets, they do tend to peak up. One day we saw the Nikkei make a new high, and then suddenly they start selling off from there. So while we are seeing higher highs, we are seeing a lot of volatility in some of the Asian markets, which have stopped making further gains from where they had made it earlier. And so that keeps us on tenterhooks whether this move is coming to the fag end. But one of the big drivers of the move essentially has been liquidity driven by a falling dollar. The dollar's been falling since March, and it was consolidating for the last few days. I was looking for a possible fourth wave bounce that could maybe retest this high point closer to 93.80 or 94. It didn't even get close to that. It's actually made a lower high and again started to fall. Today it's made a lower low as well. And today's early morning fall makes it almost look like maybe the fifth wave down, another final leg of sell-off has started in the dollar index. So that will be interesting and tricky both. The thing markets don't like is very sharp moves like you saw here, both on the way up or down. If there's a smooth move down in the dollar, it has all the same repercussions which are, risk on, good for currencies. Other emerging market currencies continue to strengthen. And I've published many times the emerging market currency index, which is right here as you see. And yesterday, in fact, I've put this chart where it's had this long consolidation, which I eventually have marked as 1 and 2. Maybe it's a complex running kind of a correction. And then it broke out of this, so the recent dollar move of last 1 or 2 days saw the emerging market currencies move much faster. Specifically, I think the Brazilian real, which was actually lagging for a while, started to decline. And so, rather I should say USD BRL started to decline. So the real actually started to strengthen. And that's what we also saw in the USD INR, right? Over just 2-3 days ago, we were not falling below this shelf support, which was at near around 74.50, which was the lower Bollinger Band. And below that, you had the 40-week average, which is the 74 level. So on weekly charts on Friday, we broke all of those levels. We went below the band, below the 40-week and closed below that. And usually breaking the 40-week is not something that happens all the time. If you look back historically, there are long periods of time the support holds. Only when you have strengthening periods, like here it broke and then it remained below that for a long period. Then once it crosses over, you have strength. So we crossed over it over a year back. right here after July of 2019. So that's after the election you actually started to see weakening in the rupee. Rallied a bit, consolidated, then you had another move up when the market corrected in March. And now you've actually gone below it. So this is the first sign that something has changed. I would probably look at this trend line that is broken. And that signals to me that maybe we are going to, test the next most significant trend line. Either it's going to be this one or this one. So this one comes in next. This trend line of the last two lows is closer to around 72.30, 72.40. That's also the point where it will end up overlapping with this high. And yesterday was the monthly close. So on the monthly chart, if we simply look at the monthly chart, what we have is a negative divergence in the momentum for USD INR. So you had a higher high and you had a weaker momentum, and the indicators actually crossed over to the sell side. So this is your currency pairs which are appearing to be weaker than the rest, like the BRL in the short term, and INR, of course, in the medium term was not even joining the rally in the emerging market currency space. Where the falling dollar was not showing up as a falling USD INR, which now is beginning to show up. And so this is the INR actually joining the weak dollar environment, and in my sense that means it has much lower to go. If you look at the 20-month average, that is at 71.9. So that is the next thing it will test, because it held that here in 2019, and this time around will it hold that support or not is going to be again the next level where you will further at a completely different degree confirm. What I'm saying is that you've probably topped out medium to longer term as far as the USD INR is concerned. Now when I say longer term, I'm not talking multi-year, because what you will be doing is a retracement of the entire advance that you've seen from 2008, but not a larger reversal. But even then it means that you have to open up to a 6 to 12 month kind of decline phase for the currency, in line with what the emerging market currencies are showing. So coming back to the dollar index, what it's indicating to me is if today's fall is the start of its fifth wave down, then probably we go back to test the 89 level. And this brings us very close to the low point where we were in 2018 or from where the dollar had actually started to rise. So that's where the first wave of the dollar index decline had ended, and had actually marked this as 1, 2, 3, 4 and 5. And since then it was in a bounce back mode. That bounce back just didn't end. Ideally ends at 61% retracement or 66% retracement, which was here. But the crisis pushed us way beyond that, almost to a double top scenario. That's what was so interesting about this move. And now once again, so far it looks like we are having an impulsive decline. And only once the fifth wave is complete would we have any meaningful pull up. But again, how meaningful? Nobody knows. It might just end up being a further subdivision and extension if we are really in a long-term bear market for the dollar. So lastly, when it comes to the Nifty, if we were essentially running into a third wave from the lows of March, wave 1, wave 2. Wave 2 was a simple ABC double zigzag, or on the daily chart you could simply see it as a normal zigzag. Then the third wave has to end somewhere. I'm just not sure whether that has happened yet. Yesterday's sell-off does give you some feeler that is happening. But the strength in individual sectors, like I said, in banking maybe, and if you do see certain stocks pick up, like the largest contributor like a Reliance, then probably we still have some legs left before this move is complete and can roll over into a fourth wave correction. But what everybody is looking for is, okay, do we really crash after this? So a fourth wave correction is only a retracement. We can only judge what that will be after the move is complete. But being a retracement or fourth waves also sometimes are triangles, which are multi-month complex patterns. Then you will get long moves on both sides in a broader trading range, which might each time end up looking like a significant fall, but will end up being in a longer term chart only a consolidation. So we'll see how that goes. Like I said, it's not clear that this particular move from this low is complete or not. The Nifty definitely giving more signs of weakness the way it's behaving than the Bank Nifty, and so that will always keep us on the hook. On the other hand, Midcaps, which have had a pretty good run, and they've in fact almost gone back to, I think, very close to the Jan highs, have been seeing a slightly slower move recently, and I think that's where you need to be careful, because once you've had such a big advance and you've broken the trend line from the just broken the trend line from the March low, Probably further advances from here will be less significant, which means you could get, even if you do make a higher high, it could end up being more of a consolidation rather than, significant moves in individual stocks. That's more apparent, though many of them have lost momentum recently and they need time to consolidate before they can actually move higher. So probably see that the broad market, which was appearing extremely strong in the month of August, might actually be more lethargic in the month of September. The weight really has to shift to other stocks and sectors.